Imagine a life where your financial worries are just a distant memory, a life where your money works for you, providing a steady stream of income whether you're working, sleeping, or enjoying a vacation. Today, we're diving into the world of income-generating assets that can help you achieve just that. So stay tuned as we explore how to build and grow your wealth, ensuring a richer future. Number 1 on the list is real estate investing. Picture this. You're interested in real estate, but unsure about the big upfront costs, rent collection, or property management. Here's where real estate investment platforms come into play. Platforms like Arrived Homes simplify this by letting you invest in rental properties for as little as $100 without the hassle of managing the property yourself. Whether it's owning rental properties or investing, the potential for passive income is immense. You can use the platform to invest $500 in a property located in a bustling urban area. Your investment is pooled with others to purchase the property, and as it earns rental income, you receive a portion of that income quarterly. Plus, if the property value increases and is sold at a profit, your investment grows too. This is a hands-off approach to real estate investment that can be started with just a few $100s. 2. Real estate investment trusts. Real Estate Investment Trust is a company that manages, operates, owns, and maintains real estate properties. You, the investor, receives passive income streams that the investment trust collects. Now imagine you want to invest in commercial real estate, like malls or hotels, but don't have millions to buy a property outright. That's where Real Estate Investment Trust comes in handy. By investing in a real estate investment trust, you're buying shares in a portfolio of properties. Let's say the real estate investment trust you chose specializes in apartment complexes across the US. As these properties generate rental income, a portion is paid out to you in dividends, usually quarterly. This is definitely a fantastic way to gain exposure to real estate markets without the need to manage properties yourself. 3. Local businesses. Think about your favorite local coffee shop or a startup looking to expand. The good thing is that platforms like Mainvest allow you to invest directly in these small businesses for as low as $100. For instance, let's assume you invest $200 in a new artisan bakery in your town. As the bakery grows and becomes a local favorite, it begins to turn a profit, and you start receiving returns on your investment. So, if let's say you invested $100 in a business that offers 1.5 times investment multiple, then you can receive up to 1.5 times your initial investment, which will be $150. This not only provides a financial return, but also contributes to the success of your local community. 4. Private art deals. Consider the art world, where investments can not only be visually rewarding, but also financially. Through Masterworks, you buy shares in a painting by renowned artists like Jean-Michel Basquiat. While the art market can be volatile, it has historically outperformed traditional investments. Over time, as the art's value increases due to demand, so does your investment. If the painting sells for a higher price later, you reap the benefits proportional to your share. It's a way to participate in the exclusive art market without needing millions to buy a whole piece outright. 5. Dividend-paying stocks. Now imagine buying shares in a company known for regular dividend payments, like Apple or Johnson & Johnson. As these companies profit, they share a portion of those profits with you through dividends, which you can reinvest to grow your holdings or use as regular income. A study has shown that dividend stocks got a 10.4% annual growth rate between 1927 and 2014, while growth stocks that did not pay dividends only saw about an 8.5% growth rate. This shows you the importance of having dividend-paying stocks as part of your investment portfolio. This can be particularly appealing during retirement, providing a steady income stream alongside your savings. 6. Index funds. Index funds offer a more hands-off investment strategy. And according to Warren Buffett, index fund investing is better, cheaper, and more profitable than in sexy investment products like hedge funds. And this is mainly due to the astronomically priced fees that come along with them. Now suppose you invest $1,000 in an S&P 500 index fund. You're effectively buying small pieces of the 500 largest US companies, diversified across industries. This reduces your risk compared to investing in individual stocks and historically provides solid returns over the long term. This is definitely an excellent way for beginners to get started with investing. 7. High-yield savings account. A high-yield savings account is one of the easiest income-generating assets that will make you passive income without moving a finger. But remember, the only time you should use your emergency cash is in case of an emergency. So how does it work? Let's say you put $10,000 in a high-yield savings account with an interest rate of 1% versus the typical 0.01% offered by regular banks. Over a year, that's $100 in interest instead of just $1. While it won't make you rich per se, it is definitely a safe way to earn more on your emergency fund, keeping it accessible and FDIC insured. 8. Money market account. Let's explore the money market account, a straightforward and accessible way to earn interest on your funds. Imagine this as a savings account on steroids. For instance, CIT Bank offers a money market fund with an interest rate of 0.45%, typically higher than what you'd find in a regular savings account. This rate might seem small, but it's a safer place to park your money compared to under-the-mattress savings, and it's far more liquid than long-term investments. For example, if you deposited $10,000 in a CIT Bank money market account, not only would you have immediate access to your funds, but you'd also earn more interest annually compared to a regular savings account at a rate of 0.01%. 9. Certificates of deposit. Now, these are akin to giving a short-term loan to your bank. You agree not to touch your money for a predetermined period, ranging from 3 months to 5 years, and in return, the bank pays you interest at a higher rate than a savings account. For instance, suppose you lock in $5,000 in a 5-year CD at a 2.5% interest rate. Over 5 years, this will earn you more interest than the same amount in a regular savings account without the risk of market fluctuations. Now, before we dive deeper into this, I want you to take a quick moment to subscribe and like the video. Your support means the world to us. Your subscription tells us you want more of what we're sharing. And those likes? Well, they're our fuel. They let us know we're on the right track, creating videos that truly resonate with you. Thank you, and let's move on. 10. Bonds. Bonds are essentially loans you give to the government or corporations with the promise of regular interest payments and the return of principal at the bond's maturity. Bonds are known for their stability and reliability as an investment. For example, investing $10,000 in government bonds with a 2% annual return provides you a safer investment route, though with lower returns compared to stocks. 11. Precious metals. Precious metals like gold, silver, and platinum offer a tangible investment that historically holds its value in times of economic uncertainty. With platforms like OneGold, you can buy and store these metals digitally, combining traditional investment benefits with modern convenience. For instance, let's say you invest $1,000 in gold through OneGold investment platform. Not only is your investment likely to hold its value during stock market dips, but you can also liquidate it anytime you choose, though it might take a few days to process. 12. Finally, let's consider an unconventional but potentially lucrative asset: rare wine. Platforms like Vinovest allow you to invest in fine wines, which have shown to appreciate in value over time. For example, investing $2,000 in a carefully selected portfolio of fine wines could see significant appreciation over a decade, outperforming traditional stock investments in some cases. As you can see, diversifying your portfolio across a range of assets from the very safe to the more speculative can balance your potential risks and returns. Whether you're investing in something as traditional as CDs or as unique as rare wines, understanding each option's pros, cons, and suitability to your financial goals is key to building a robust investment strategy. Remember, the best investment strategy is one that is well-informed and aligns with your personal financial objectives. So go forth and invest wisely, for your future self will thank you. Until next time, happy investing, and don't forget to like and subscribe.